Hello, everybody. Luke Gromen, FFTT. Hope you are well. Get the applause track in here and use that. Thanks for joining me, as always. I appreciate everybody who submitted questions. Very helpful. Really enjoy these discussions. And so I'm going to jump right in the interest of brevity. The first question comes from LB. Can you tell me what's happening like I'm 5? Did you ever play Monopoly when you were a kid? So imagine playing Monopoly, the board game, and you were coming around the final stretch of the board in the back stretch, and your friends, you're coming around the back of the board with only $100 left. So you've only got $100 left, and your friends have hotels on Yellow and on Green and on Park Place and on Boardwalk. And if you land on any of those things, or if you land on any of the penalty areas that are over $100, you're broke. So you're rolling the dice, and you're praying, and you're blowing on the dice to roll them, and you're hoping that you can somehow get through that minefield. That's half the problem. Now, the other side of the problem is that your friends do not own any of those hotels paid in full, but rather they have borrowed and mortgaged the properties that they bought throughout the game, and they've mortgaged their bicycles to buy those hotels. And they're levered 10-1 because they put 10% down on their commercial real estate loan on those hotels. So if you land on the hotel and you owe them more than you have, you're going to go broke. And when you're unable to pay them in full, they're not going to be able to make the payment in full, and they're going to have to start selling or getting foreclosed on the properties they mortgaged to buy those hotels. So what's going to happen? You got to roll the dice, and if you land on something, your dad has to come in or the banker print the money for you to pay them so that they don't default on their hotels and get their mortgages, and so that somebody ultimately doesn't get angry and tip over the whole board and have it devolve into a fist fight. And that, in a nutshell, is what's happening. With the fist fight being the risks of outright war between the U.S., China, and Russia, which I think is still small, and I think as of this week, minimizing quite potentially greatly, but they're still there. So I think that's a pretty good metaphor of what's happening. Next question, a number of questions about gold revaluations. To continue the metaphor, it's a way to continue the Monopoly board game. Ultimately buys time. The U.S., it's an accounting identity. No physical gold has to move. U.S. has 261 million ounces of gold, roughly. Every $4,000 per ounce that the Fed revalues Treasury's gold deposits $1 trillion into the Treasury General Account, which reduces the amount of Treasury issuance that Scott Bessent would have to issue that year by $1 trillion. So it is a way to effectively create M2 money supply using gold instead of by issuing Treasury bonds. It's money printing using gold. Full stop. So it's inflationary. It's stimulative. It is gimmicky. It is no less gimmicky than QE was when we first started this whole process. If you recall, 2008, pros in the business, I can tell you, we were all looking at the numbers going, oh my gosh, they're screwed. The entire system's going to come unhinged. We're done. I mean, I literally had a portfolio manager at a major institution. We were having a cup of coffee, and I said, I don't know what they're going to do. He said, well, they better figure out soon because you're going to be out of a job and I'm going to be out of a job if they don't. That's how bad it was. And then all of a sudden it was like, oh, they can just do QE on $1 trillion in treasuries, and away we go. And in the same way that we're running out of room now, then we're running out of room now. And it's going to likely take something outside the accepted Overton window of discussion that injects liquidity to fix this. And there's other things they could do, but ultimately it needs to happen. And it needs to happen relatively soon, not just given where we are from a fiscal perspective, but we've got a midterm election just 18 months out. And these changes take time if you're going to inject liquidity to get things going. And so you need some runway. So to me, it speaks to something outside the Overton window of acceptable policy discussion happening sometime in the first half of this year. So as I say, let's watch. From MF, I still don't get the oil market inflating versus gold market inflating argument that you brought up. Can you explain this more simply? How can they choose to inflate a certain market? Also, side note, wouldn't the US have a bigger incentive to inflate the oil market? In the 1970s, the choice was made to inflate the oil market. There is a book, Century of War, by William Engdahl. More importantly, there have been multiple interviews given in the public by former Saudi oil Sheikh Yamani, specifically saying the decision was made at the 1973 Bilderberg meeting in, I forget the long name of it, but it's an island in Sweden. Basically, it was oil's going up 400%. Get on boards, guys. And oil was revalued. There's a famous quote from, I believe it was also from Sheikh Yamani, who asked the Shah of Iran, why are you raising oil prices 4x? Shah of Iran said, I don't know, ask Henry Kissinger. So oil prices rose 400% from October 73 to April 74. It made oil much bigger to basically recycle dollars back to support the Treasury market, to support U.S. deficits, recycling deficits, U.S. deficits in the oil market. And so it was a decision that was made. Now, they could do that because U.S. debt to GDP had already been devalued from 110% in 1945 to 55% by 1951. And by 1973, it's like 25 to 30% debt to GDP. So taking oil up a bunch is stagflationary. It slows growth and it increases inflation. And so stagflation is very bad for bonds. But with 25% debt to GDP, 30% debt to GDP, there was no credible way that stagflation was going to threaten the solvency of the U.S. government. That is no longer the case. You do something stagflationary with oil like they did in the 70s, at 125% debt to GDP, the Treasury market can't withstand it. You're going to slow growth, you're going to increase inflation, and the U.S. government can't really afford 10-year Treasury yields above 5%. So you're going to go into a debt spiral in the U.S. and around the world. You're going, if you rate, because debt is so high, the amount you'd have to inflate oil would probably be more than they did in the 70s, which, given debt, would not just hurt the economy, but it's a real economy issue. You're gonna really drive the economy down, and you're also probably going to starve tens, if not hundreds of millions of people, because oil is a key input to agricultural productivity and therefore ag prices. Okay. That means you got to inflate something to recapitalize sovereign and central bank balance sheets that isn't used for anything. Now, what is on central bank balance sheets that isn't used for anything? Gold. That's it. Revalue gold enough, recapitalize the system, move on. Bitcoin, in theory, can serve a role like that for the people. But again, as we speak now, the central banks have no Bitcoin on their books. Abu Dhabi did buy some for their sovereign wealth fund. But again, the only thing on central bank books that isn't used for anything, that can be inflated as much as you want without breaking anything, is gold. Okay, question. What are the implications of all this physical gold moving out of London on the dollar? Ultimately, the higher gold goes, the more, all else equal, it's a big caveat, all else equal, the more it puts downward pressure on the dollar. Mechanically, but then also ultimately, gold draws capital flows from the U.S. And from treasuries. So I think it can be used as a way to constrain the upward pressure on the dollar created by Doge, created by a recession, created by the yawning gap between price-insensitive buyers of treasuries and the size of our deficits. But ultimately, I think that's the key takeaway. From CR, estimates show that Europe needs to spend about $3 trillion plus to boost its defense capabilities. If they print $3 trillion in euros, won't the dollar go up versus the euro? Does this mean the U.S. could print $3 trillion to spend domestically and DXY would be relatively unchanged? If we need a weak dollar, can we spend $4 to $5 trillion? The theory of it, that's right. There's other puts and takes, but just all else equal, yes. And ultimately, that's why I continue to think all roads lead to gold, and why I also like Bitcoin so much is, at the end of the day, pretty good chance that both sides are going to spend a lot of money on a lot of stuff, and I don't know the order. And if I own dollars, if I own euros, I've got to be right on the order. On gold and Bitcoin, unlevered, I just have to be right that they're going to do it eventually. I don't care about the order. So that's why I continue to be as heavy in gold and Bitcoin as I do one of many reasons. From DC, Luke, regarding Tree Ring's report of February 7th, Tree Ring number 5 on the crypto czar and stable coins. Great explanation that even I understand. My key takeaway, surely this takes away the neutral status of Bitcoin, given the implicit and explicit linkages with Treasury T-bills. In theory, I don't think that's right. I disagree with that. I think ultimately Bitcoin remains neutral. The underlying stable coins clearly are tied to T-bills, but so if I want to move in and out of the stable coin system, back to in and out of dollar-based banking systems through sort of the on and off ramps, yes. But in theory, if I don't like, or if I have to, let's say real extremist, flee, I can literally get on a plane, fly to a country, leave everything else behind, work scrubbing floors at a restaurant for a few weeks or months, store up, buy an iPhone, download the app, put in my passwords, and voila, there's my wealth in Bitcoin. So it's still neutral from that standpoint. So that's, you can move it in and out of dollars, but in that case, I could also move, I don't have to have the dollar to do that. So that's why I think it's still neutral, even with the more, the bigger link to U.S. Treasury T-bills. From KW, you have previously said the Trump administration must weaken the dollar. DXY is near 2022 decade high. How much lag time and what's the canary in the coal mine with regard to Doge spending cuts with a strong dollar? So, 2022, we were at 114. We're at 106 today. It's still, I guess, close enough for government work to 114, but it is down since then, 6-7%, which is not insignificant for a currency as important as the dollar. With that said, we have seen the dollar fall sharply versus gold. The dollar's down 80% against gold since third quarter 22. Gold's up 80% since in dollar terms since the third quarter 22. And that can be a mechanism for dollar liquidity, like we just talked about, by weakening the dollar. You could also do it mechanically via some sort of revaluation of U.S. gold into the TGA, like we just talked about. Regarding spending cuts and the implication and the race between spending cuts and some of the other dollar positive stuff relative to liquidity being supplied or a weaker dollar, I'm watching growth, right? So take a look at Atlanta Fed. Atlanta Fed's gone from 4.1 to 2.3% real growth in 3 weeks. If that keeps going, that means we're going to need more dollar liquidity. NAHB Builders Survey was a little soft. Retail sales. Again, these are all kind of one-offs. I don't want to make too much of it, but I'm watching growth. Let's see. Look, at the end of the day, GDP, 25% of GDP is federal government. And not only are they cutting, but they are going to startle the spending of everybody else in government. So you take 25% of GDP and introduce a whole lot of uncertainty, it might matter. So that is worth, that's on watch. I'm watching receipts, which have been okay in the latest data. Deficits, which have been a little scary. True interest expense is 109% of receipts, 117% of receipts if you include VA. I'm watching the dollar, which is telling us things are okay, right? We've gone from 114 to 106 over the last 2.5 years. I'm watching equities. So far, so good. I'm watching the 10-year, being managed according to both Bessent and Trump. And again, today, Bessent saying, well, I can't really term out the debt yet. So it is a multi-body problem. It's not as simple as look at one indicator and go with that. It's not what I would recommend doing. And then the final question from MG, longtime Tree Ring subscriber, Luke. Thank you very much for your business. We appreciate it. Where could your thesis be significantly wrong? Is there a world where the U.S. can reduce the deficit enough and maintain just enough growth for the status quo to remain for another decade or more? I would revise thesis, less thesis and more understanding of optionality and trade-offs. In other words, can we reduce the deficit and reshore without yield curve control? Probably not, right? We reshore, growth goes up, inflationary pressures go up, rates and wages go up. Rates go up, you go above 10 or 5% on the 10-year, and all of a sudden we've got a problem. We've seen that over and over and over. And so more importantly, if rates go up on 120% debt to GDP, deficit's not going down, deficit's going up. You got to get debt to GDP down first. That's why I keep saying it over and over and over and over. Unless we yield curve control, unless we have negative real rates. Okay, right? So those are trade-offs on one. Another example. Can we maintain the status quo for another decade? It depends. Do we want to have China making virtually all of our military equipment and inputs for us in 10 years, which is what Rubio said will happen in his confirmation hearing if we don't change? My view is there's zero chance that's going to be allowed to happen. But if we want to keep this status quo, then yeah, of course we can. We'll just have to ask China nicely to make weapons to surround China in 10 years, and away we go. Failing that, no, it's not sustainable. Can the dollar super spike? Well, sure, theoretically, if the United States government is willing to allow treasury auctions to fail repeatedly and spectacularly, and U.S. interest expense then crowd out all other areas of government, and we don't print the money to make up the difference. And so if we're willing to do that, then yeah, the dollar can super spike. Failing that, it's not going to happen. It's not going to be allowed to happen. And so when we look at these different trade-offs, then we say, okay, well, where could our framework be wrong? You have to believe it's some sort of very much out of the Overton window, right, of discussion. So some sort of technological shift that not only revolutionizes and drives productivity, but it does so in a way that it does not put deflationary pressure on wages or on employment. Because again, the debt's too high. You take wages down, you take employment down, people's mortgages don't go down with their wages, right? So all you're going to do is introduce a debt spiral and a banking system crisis. We know this because we saw it in 2001 through 2008 after we offshored a bunch of jobs to China. That was a productivity miracle. And we gave everyone a subprime loan so they could go out and buy a house and a bass boat on a much lower wage, and it all worked fine until home prices rolled over. And then it all fell apart, and the Fed's balance sheet grew 6x. So same kind of dynamic here. You need a productivity miracle, but a productivity miracle that doesn't put deflationary pressure on wages or on jobs. Good luck with that. That's unusual. Got to get the debt down first as a percent of GDP. Got to devalue the debt. Some sort of grand détente. Again, between not just China, Russia, and the U.S., but China, Russia, and the U.S. in a way that China and Russia voluntarily return to the ex-ante, where they basically put themselves into the position of 1995 to 2005, where they're economic vassals, reducing their standard of living to increase ours. Possible, I suppose, but I wouldn't think it's very likely. And so, those are the types of things it would require. I mean, you can for me, it's less about any single thesis, and it's more looking at the constraints on the system, and not just the constraints of the math, but the constraints of the politics and the real politic. And when you start sort of laying those things out, you start to realize the path is getting narrower and narrower and narrower. It's starting to get pretty biblical, fat man through the eye of a needle, or camel through the eye of a needle. So I was quoting Sting, not the Bible, sorry. The camel through the eye of a needle. So at any rate, thank you as always for joining me. If you like these updates, check out FFTT-LLC.com for more information about our tree rings product, 10 most interesting things. Brief synopsis on what grabbed our attention about them, whether they're confirming or refuting a way we'd previously been thinking about the world. So as always, everybody have a great rest of your week. Thanks for joining. We'll talk with you soon. Take care, everyone.